Oh, hello and welcome everybody. How are you doing, Lisa, on this beautiful, beautiful Thursday?
I'm doing excellent. How are you doing?
I'm doing good. I'm excited to kind of dive into our topic. I think um, it's probably very well underutilized. So I'm interested to hear a bit of your take on it, and hopefully vice versa. We get to learn something from each other and partake some education on the people out there viewing and listening.
Yes, definitely.
How about we start with a
Fun
little
stuff.
disclaimer?
The fun stuff. So, just to let her know, we are not giving financial advice. We are not licensed advisors. This is strictly educational. This is sharing information that we have. This is our experience. But make sure you consult with financial advisors, legal team, CPAs, tax professionals before you do anything or act on any of the information that you do here today.
Yeah. How about tell the people listening a little bit about yourself and well, and I will do the same right after.
Okay. So my name is Lisa Moore. My name is Lisa Moore. I'm located in Salt Lake City, Utah. I grew up in Massachusetts, moved to 16, and that's when I got started in real estate. I started house hacking and then got into buy and holds. I always liked the appeal of having the cash flow as opposed to fix and flips when you're doing all this work, getting a chunk of money, and then it ends after the fix and flip is done. So um, now my husband and I, we own over $7 million worth of real estate. We've been involved in over $40 million worth of partnership deals, and love to educate people on it. My background is financial analysis. I was an analyst for about 17 years in the corporate world before I retired from that in 2021 to focus 100% of my time on real estate. So I love the numbers, love getting into that, talking budget and finances and educating people on that because it is something that is not taught in our schools enough. And a lot of the tools that actually matter in life, like self-directed IRAs, are something that I didn't even know about until several years ago. So,
Yeah. Thank you for that, Lisa. Yeah, I definitely knew about it, but didn't necessarily know best practices, which I think is probably more so profound. I think a lot of times, especially with the IRA accounts, even when we talk about retirement, it's so funny. Like, are you retired currently?
it depends what you consider retirement.
Exactly, and that's kind of
Oh,
my point. Like, I think people think retirement, and they think old people in homes, in assisted living facilities, and I think that's what the general population thinks about. But you were able to I guess break through financial freedom and retire from your W-2 a few years ago. Same with myself and my wife. So just real quick, a little bit about myself. I have a background in I wouldn't say finance, but more grocery retail, but on all aspects of it. I was a CEO of a very large retail corporation back in Hawaii, in California, and I did that for almost 30 years before we retired. And I started at a very young age in the corporate world, and was able to walk away from my W-2, but was through strategic investments planning, and just kind of navigating through those, I don't know, sometimes minefields. Well, however you want to look at it, but and I guess we're here to sort of help you navigate through it yourself and give you some, again, some of the things that we've done, some of the things that we've learned along the way, and hopefully we can go from there. So I guess first thing is, I'll just ask you the question. So Lisa, on your side, what do you think the number one thing holding people back from using their retirement accounts effectively?
I think the biggest thing is they don't know what their options are. That's probably the biggest. And if they do know, they probably don't know how it works or what the process looks like. So that sort of fear or that kind of barrier of how hard is this going to be? How time consuming this is going to be? I got to take care of my kids and bring them to soccer and go to this meeting, go to that, not knowing like, is this going to be a super long process or is this really easy? So I think that not knowing that what they can do and then not knowing what it takes to get a self-directed IRA set up to me are probably two of the biggest reasons from people I talk to that they don't utilize them.
Yeah, I think I'll piggyback a little bit on that. I think a lot of times people are afraid of what they don't understand. It's kind of shocking if you think about it. People spend 40 to 60 hours a week working for money, right? That they're going to get a paycheck on, for money they're going to get a paycheck on, but they won't spend 1 hour a week just figuring out how to navigate that wealth journey for themselves. It's kind of crazy to kind of think about it, but I say let's kind of like look at it, and we have it, the three biggest myths. Let's kind of talk about what we feel are the myths out there and how we can put a kibosh to it.
Yeah. So myth one, I can only invest my retirement money in the stock market. I don't know if I ever was at a company where when they were discussing their 401k ever mentioned anything outside of the stock market, because most companies with your 401k, you have to invest just in the investments that they offer. So they don't realize that you can do a self-directed IRA. Not every company will let you move their active one, but once you leave a company, a lot of people don't know, like they forget about it. It's like, where was that retirement account? What company was that with? And they sort of forget about their retirement accounts as they move from company to company. But you can invest in alternative assets like real estate, private equity notes, things like that. The traditional advisors are going to stick to stocks and bonds and things like that. But you are allowed to invest in a much broader range of investments than what you're told through your 401k and your IRA with most traditional brokerages.
Yeah, it'd be interesting. I don't know if you heard the news, but it'll be interesting to see how that transpires, because the Trump administration did just open up private equity and different types of alternative investments to 401k accounts. Now, obviously, the companies will have to elect to be able to offer those. So it will be interesting to see how that transitions. But kind of, again, going back to my original statement, I don't think anyone's going to care more about your wealth than you do. And a lot of times, a 401k, especially a 401k, is normally set up to just do mutual funds. And it's a super small set of mutual funds, and the fees are like astronomical. So it's just be interesting, though. I would say, okay, myth number two, all IRAs are the same. I'll have a funny comparison to that. Is that it's kind of like saying all vehicles and cars are the same. Yeah, obviously they can all get you from point A to point B, but try pulling a boat or a jet ski with a Prius. Not the same thing. Or even a mobile home, right? Your RV, and try to pull one of those bad boys with it. So it's not the same, but there are definitely different vehicles that you can use that offer different benefits. Most of them are going to be tax related. There are we're not going to go through it, but there are going to be reasons why you want to use a retirement account, and they're going to be I would say a much smaller handful of reasons why you wouldn't use a retirement account. I think retirement accounts are good options if it fits your criteria. And again, it's going to fit the most majority of people out there that are looking for some kind of tax saving, because I think hopefully everyone knows that one of the largest bills you're ever going to have is paying Uncle Sam. So a bunch of different vehicles that you can use for various different reasons, and they're all different. Some are going to be pre-tax, post-tax. Some are completely, well, there's only one that I know of that's completely tax-free. But there are definitely options for you to be able to limit your tax liability now or in the future. So it kind of depends on your situation and on what you're going through to be able to figure out exactly what account to set up.
Yep. And before I do with number three, if anyone has any questions during any of this, make sure you drop it in the chat, post it, whatever, and we will make sure we answer any question that you guys do have. So, but myth number three, I have to wait until I'm 59 and a half to benefit from my retirement savings. Well, yes, you cannot withdraw from that without penalties and fees, but you can still invest in things that are going to be active, like real estate. It doesn't just have to be the stock market, as we've said. You can invest in active real estate deals that are going to be cash flowing. These returns will go back into your IRA, but you'll be able to potentially see those returns and see your retirement growing faster. So you don't have to necessarily wait decades to see the snowball effect with stocks. You could potentially start to see that earlier if you're doing active real estate investing. And while retirement accounts are definitely great, and like Chris said, pending your situation and what you're looking for, tax benefits, things like that, something to consider that 59 and a half is you can't withdraw from that. So if you do want the chance, the opportunity to retire before you're 59 and a half, whether that means, hey, I want to retire in my early 50s, but that might be I want to work seasonally, or I want to work part-time, just not be full-time at a W-2, then you do want to make sure you invest outside of retirement accounts as well. So you do have access to money before you're 59 and a half, and everything is not tied up in retirement accounts. I've talked to several people that are in their early mid 50s that they knew that they couldn't touch them, but until they actually got to the point where they're like, wow, I actually probably could retire in the next couple of years and do part-time or seasonal, but all of my money is in retirement accounts. So that's another thing to consider as well. They're good, but
just a few added clarification, because you can access certain accounts, you can access your money. So from a Roth account, you can access the original principal going in because it's already taxed. You on the Roth side, you get taxed prior to going in, so you still have access to the principal, but the principal obviously won't be compounding in whatever investments you have if you pull that out. So there's still some options, and then even outside of retirement, I know we're talking about retirement accounts, but there's HSA accounts where you can actually have access from the day you set it up. So there are different mechanisms to be able to, and you can invest, and you can set up a self-directed HSA account as well and invest that way into alternative assets or whatever else you feel like it. So there's definitely options there.
Yes. And that is
now we're going to talk about a little bit more about how the SD IRA works. So I would say, if those of you are out there, let's drop it in the chat. If you could, what do you wish you could invest within your IRA? I'll give it a few minutes. Oh no, actually not a minute. Let me give it like 30 seconds. And while we're talking about that, I think a lot of times there is a general misconception as well about what you can invest in with your IRA account, especially since the majority of population know and understand retirement accounts through a normally through a 401k or like an Edward Jones or Fidelity, where you set up an account and you have someone helping you manage that account for you. Now, when you're looking at it, I think it's honestly easier to go down the list of what you can't invest in, because there's kind of only two items that you cannot invest in. One is like collectibles, so like gold, artwork, stamps, those types of things, which are still investable assets. You just cannot invest in those assets through your IRA account. And the second is life insurance policies. So you cannot fund a life insurance policy with your retirement account. Those are really the only two things. There are some transactions that you can and cannot do. So there's definitely prohibited transactions. So as you're navigating this world, it's really easy. You just talk to a custodian and have the custodian kind of help you navigate those things. So I want to hear real estate. Absolutely, that's what we all want. I mean, we don't all want that. I mean, there's different segments that you can definitely invest in, but I think it's one of the things that we currently all invest in. And I have a large majority of my retirement investments in real estate as well. I have some outside of it, but a large proportion of it in real estate. So thank you for your comments there. And we'll go over to the next one.
Yeah, so what in the SCIRA custodians can and cannot do. So they are not a financial advisor. And that, I think, is something that you really need to make sure you understand, is you're not going to go to an SCIRA custodian and have them sit down with you and give you financial advice and tax and investment and tell you, oh, this is a great deal, anything like that. Like, they cannot guide you. They cannot give you tax advice, investment advice. They can't prevent you from making a bad investment. They cannot conduct due diligence on any deals. So they are there to make sure that your self-directed IRA, you come to them and say, hey, I have real estate deal 123 Main Street. They're going to make sure that your paperwork is correct, that you're abiding by what the rules and regulations are with the IRS, and that you're in compliance. They'll make sure you get your statements and tax forms that the IRS requires. So they're going to make sure that everything is done legally, but they are not going to guide you on what your investments are, whether it's a good one or not. They're not allowed to do that. So it's great to work with both. Obviously, if you have a self-directed IRA, you have to go through a custodian, but just know that they are not going to be somebody that is going to be able to give you guidance. Your financial advisor is going to be the one that you want to go to for that type of advice.
Okay, perfect. Let's talk about financial advisors. Good segue there, Lisa. Love the segue. So, if you're going to not again, there's nothing wrong with financial advisors. They're definitely not knocking them at all, but they are regulated. So, if to become a financial advisor or a broker dealer, you have to get licensed. So you have to pick up either your your Series 7 or your Series 65 license. And the license is governed by FINRA or SEC. So those are governmental bodies that they basically govern securities, the exchange of securities. Same thing with the stock market, right? They govern all of the things that happen there, put rules, laws in place to generally protect the population from being taken advantage of. So there is a fiduciary responsibility under the financial advisors, which again is a good thing, but their license only covers securities. So, and when I say securities, it's the typical securities on the stock market: stocks, bonds, mutual funds, ETFs. That's what their license covers. They're not trained or even permitted to advise on private placement. So it's things like real estate, syndication, direct lending. They actually legally can. So a lot of times you're going to ask that if you was to directly ask, which I know that's one of the things we said on the disclaimer, but if you're going to directly ask, can I use my retirement to invest in real estate? They almost always will tell you no, or they're not going to give you an answer that's helpful. So you still have to be able to navigate it on your own. Just again, it kind of goes back to my statement in the beginning. Like we put 40 to 60 hours, if in my case, over 100 hours, 80 to 100 hours a week working, right? Trying to bring home a paycheck, make a life for yourself, but we won't spend that 1 hour a week, 2 hours a month just to learn and educate yourself on the ways that you can grow and generate your own personal wealth. And I promise you, if the people that are watching in now, if you just take a few hours, I mean, there is nothing wrong with having a W-2. You might love your W-2. If you love your W-2, stay with it. There's literally nothing wrong with it. But educate yourself to be able to grow your wealth along the journey, because you never know what's going to happen as time changes, right? You want to be able to give yourself the freedom to make the choices you want to make. It's not just about, again, that retirement and I'm going to get old and I'm going to be in an old folks home. It's definitely not about that. It's about giving yourself the choices to be able to choose what you want to do when you want to do it. And if that's okay, instead of working 40, 60 hours a week, I want to work 10 hours a week and I want to spend the rest of the time doing something else. You need to have a plan in place for that. So again, just spending some time figuring out how to navigate and grow your wealth.
All right. So how advisors are paid. So most advisors are paid based on the AUM, which is assets under management. So if they have $1 million, $10 million worth of investments with them from all their clients, they're getting paid a percentage of that total. So for them, if you come to them like, hey, I want to invest in real estate, what should I do? Who should I use as a self-directed IRA? They're now going to have less under management, so they're going to get paid less. So they also don't have as much of an incentive to guide you to lead you to take your money from them and to take it elsewhere. I'm friends with a wealth advisor, he calls himself, and he works with all very high net worth individuals. And he's kind of in a different bracket where he also works with, because he knows his clients, like they need the tax benefits. They literally are just like, I don't care, it just breaks even. I need tax benefits. So he works with other people within his team that he advises on just what he can do. But then when they have clients that are like, I want real estate, they have somebody else on their team that, hey, that's your area. But a lot of advisors are not going to suggest, because as soon as that money leaves their accounts and it's no longer under their management, they're now getting paid less. So they're incentivized based on their commission structure to make sure that they're keeping as much assets under management for them to be getting that higher paycheck.
So it is kind of an oxymoron, right? If you think about it, right? I mean,
especially fiduciary, because a fiduciary, so there's advisors and then there's fiduciary. So not all advisors are fiduciaries. Fiduciaries have gone extra steps to basically say, I'm ethical and I'm going to always make sure I advise you in the best way possible. But the best way possible could be you taking your money away from them. So yeah, it can be a tricky thing.
Yeah, I know it's kind of funny how it works out that way. But again, I think at the end of the day, you guys just have to learn to kind of navigate it. Not all professionals are the same. A doctor is not a doctor for anything, right? A lot of times they're specialists, lawyers. A lot of times they're specialists. Same thing, right? So you go to your financial advisor, or your registered advisor. It's the same thing. They should know and understand the equity market. And again, to some degree, because you look at different, and they're not going to all be the same. They're not going to have all had the same education. It's literally, I probably have it here. There's one book, because I was this close to getting my Series 65 license, and I was like, it's just a license. I don't necessarily need it, but you basically you study a course, go through a few classes, take a test. As long as you pass the test, you get your license. So again, that doesn't mean that they're going to be able to financially navigate you through all the nuances, the tax nuances, the legal nuances, or even the financial nuances for that matter, to be able to get you the most that you can get. Though I'm going to be honest again, at the end of the day, the person that's going to care most about your money is you. So take some time, get yourself educated as much as you possibly can. We are going to switch topics around here a little bit, and let's talk a little bit about some of the math behind it. So if you're looking at it, I think a lot of times we look at, so passive real estate, we had one person say it, right? They already said they wanted to invest in real estate. And you look at it from the active or passive side. Now, can you actively, let me ask you the question, Lisa, can you take your IRA account and actively invest in real estate?
Yes.
Yes. The answer is yes, but yeah, there's a bunch of buts again, and your custodian can help you navigate what those buts are. Because there's definitely things you can and definitely things you cannot do. Like you cannot go buy a rental property with your IRA and then move into it. That definitely does not work. You can literally disqualify your whole entire retirement account, and then you basically have no tax shelter and no reason to even have a retirement account at that point. So in order to keep the tax benefits, there are definitely things you can and cannot do. So you definitely have to educate yourself. And again, a custodian, whatever custodian you guys go with, the custodian can help you navigate what you can do and what you cannot do. On the real estate side of it, passively investing in real estate, it really opens up to almost anything. Because you're not the biggest detriment about actively investing is you personally cannot benefit from the investment of the retirement account. I know you personally benefit when you become 59 and a half, but before that point, you cannot benefit from any of the investments. So again, think of the best way I heard somebody articulate to me is just think of you and your retirement account as two separate people and two separate entities that cannot play with each other. Basically, you guys don't like each other, keep you guys stuff separate.
That's
I think
probably one. I'd say that's probably one of the things that I hear the most conflicting when talking to people is there'll be some people that are like, no, you absolutely cannot invest in your own deals, blah blah blah, and other people are like, yeah, you absolutely can. So there can be a lot of kind of misinformation and people that are very hardline one way or the other. You just have to know exactly what you can and can't do if you're going to actively invest and invest in your own deals. And that's where a good custodian comes in, that you can see like, okay, I want to buy a rental property. What am I going to be allowed to do? What am I going to not be allowed to do to make sure that I stay in compliance and that I'm not breaking the rules and going to cause myself to lose that tax shelter. So
absolutely. So we're going to kind of talk a little bit about two different scenarios just to give you guys some food for thought. We're here, both of us are here in Utah, so we're going to use Utah as the baseline for our comparison. And just to give you, and this is just Utah, so please take this with a grain of salt, because we are only talking about Utah, and there's definitely several markets where you can get better performance, and certain markets you can get worse performance. So because we're both here in Utah, it's easy for us to just grab the information. What we're gonna do is, again, we're gonna talk a little bit about the math. We're going to go into the math side of it, and we're gonna compare what you can get on a rental versus what you can get through maybe some passive investing. We just, full disclosure, our fund primarily invests in debt. We've been doing it since everyone else started jumping on debt. It seems like in the past year, when equity hasn't been performing, everyone else has been jumping on debt. But I've been doing debt for the last 4.5 years. I had 2.5 of personally just investing my own money, and then we brought it over into the fund and started helping other people along the journey. So we're going to do a quick comparison. And again, please take this with a grain of salt because it is only Utah.
And I do, if you currently own rental properties, I would be curious, put in the comments if you do own rental properties. I own a portfolio. I know Chris owns stuff. And that's also why we are looking to do more passive stuff, because it has been.
That's a good point. So I quickly found out I didn't want to own single family houses. This is after I think we purchased like 3 or 4 of them. I was like, okay, wait, I do not want this anymore.
Yes, and it's very dependent on what you're doing. Like we still own stuff. We still own almost 40 doors, or I think like 30 or 39 doors. Like, it has been an enormous building block for us, house hacking and then starting to do buy and holds. It has been crucial to getting us where we are, but you just progress throughout your life, throughout your investing. So you might want to be starting, hey, I want to do more active and things like that. And we'll go over kind of example comparing the two, but it's really like what fits you. Like, I know people who absolutely love managing stuff and who love dealing with tenants and short-term rentals and things like that. I do not. I don't mind the tenants the long term. I wouldn't say I love it, but it's like it's choosing your hard. Like, you're always going to be doing something. At least me, like, we're always doing something. It's what do I enjoy doing? And for us, the long-term rentals were the best option. We don't want to continue to grow a giant portfolio because we don't want to take in any more time. The time we spend on it now is kind of the most that we want to spend on our active real estate for the portfolio we have. So transitioning to the passive is been great for us because we can still invest in real estate. We can still benefit from it, but it's far less active than us having to deal with going and buying the properties and stabilizing them and getting the phone calls. And we get enough of those now with our portfolio. We don't want any more. But it's knowing what your goals are, what you're looking for, and knowing what's going to fit you best. So this will be a good example of showing the active and passive and kind of just a sample of what things can look like.
Yeah, I think a lot of people too, if I can kind of interject, I completely agree 100% with that. But I think when we're looking at investing too, we need to look at like a diversification of portfolios and a risk return profile. So like allocating the amount of money that you have to invest versus in risk versus return, and making sure that you have a well diversified portfolio and risk, because there's cyclicality to everything. Like everything, again, if you guys remember real estate, honestly, even real estate in the last year has not been performing the way it has been performing historically. And then if you look at, I'm sure everyone remembers 2007 to 2009 when real estate took an absolute tank and a lot of people lost everything that were invested in real estate. So we love real estate. We love the opportunities and the freedom it gives you. But I also like to kind of interject that you should have a well diversified portfolio, especially something that you're using for your retirement. And you need to be able to understand risk levels that you're taking on and be able to allocate the amount of resources according to the risk profile that you want to take on. So you want to have a larger model, depends on where you're at your investment horizon, but you want to have X amount in safer investments, and then you want to have X amount in maybe more growth investments, and then maybe a smaller amount in high growth investments. Because again, when you're looking at the growth, I mean, everyone would love it if it's just high growth, zero risk. That doesn't exist. So you want to be able to allocate growth and risk together within your bucket. So we're looking at, and let's just pick a rental, because a rental is on the higher risk side of the portfolio when you're looking at it. I mean, I would say mid. It's probably mid-term. It's not low risk. It's not high risk, but kind of right down the middle in the risk. But again, on the higher, slightly higher risk, you should get slightly higher rewards and returns. So I just quickly scanned the market. It's a pretty nice property. It looks like it was recently renovated. I don't think it's a stage house. I think it's somebody lives in it, but recently renovated. And I picked this one specifically because they're claiming they can yield 3,700 in income. So I also picked this one because it does have an ADU on it, which is, again, it's a dwelling unit. It's basically like 2 units in one house. So this would be kind of an optimal investment property. Again, really kind of a nice looking property in a good neighborhood. This is the nicer side of West Valley. There's some different sides of it, but this is a nice side of West Valley, nicer house. And so we're gonna kind of just do a comparison. So I'm gonna take the comparison, assuming we invest somewhere around $100,000 into a rental property. So this is slightly below the median price point here in Utah. I think median price points are like 560, somewhere in that area in Salt Lake County. So this is slightly below the median. But again, I picked this specifically because it has 2 units. I can rent out the top and I can rent out the bottom if I wanted to. So I'm looking at this again, really nice house. You guys get the idea on the house, really beautiful interior. So pretty much turnkey. There's nothing I really have to do with it. So I'm obviously taking on slightly less risk because it's turnkey. Now again, let's look at some of the math. So I quickly put the math in the quick little calculator that I have, just so that we can see exactly what it looks like. So this would be my principal. Let's just assume I have to put 20% down. It's going to be slightly more than the 100,000, but it's close. It's close enough. It's $5,000 off. And so let's just wash it and say it's $100,000. Now I have my payments. So the payments I'm going to make each month. I got taxes and insurance, and then I got my rent payment. I think a lot of times people don't necessarily put into consideration in the calculation vacancy, repairs and maintenance, which is going to come up, and then you should put some kind of capex reserve because something always happens. The water heater goes out or something happens. So you want reserves, and you want to be able to account for those reserves in your numbers. You should always have a property management fee as well. Even if you don't have a property manager and you're doing it yourself, you should be paying yourself. So you want to make sure that you have all those numbers in it, because again, you get to a certain stage in your life, like Lisa said, even if you're managing everything now, I promise you will get to the point where you do not want to manage it anymore, and you're going to want to hire it out. So this is like Lisa's smiling, she's agreeing to it, and it's not easy to find a property manager. Lisa can definitely attest to that. But you're going to want to find a property manager because you're not going to want the 2 a.m. calls that my son flushed a G.I. Joe toy down the toilet and now it doesn't work, which is going to happen, I promise you. So this is what it looks like at the end of the day. I have a negative cash flow. Again, this is Utah, so take it with a grain of salt. I have a negative cash flow on the property. However, this is still Utah, so this is more of an appreciating market. So if I want to continue down, I'm going to just estimate, and this is where more risk comes in, because I'm estimating a lot of these things. I'm estimating what my vacancy will be off of historical numbers. I'm estimating what my expense rate will be, and I'm estimating what my rent increases will be over the course of the years. But I have pretty conservative estimations in here, and let's just say I hold it for 10 years. After I hold it for 10 years, I'm going to get a return of 2.49 times my return. So when I sell it, I'm going to get a profit of about $200,000, which is not bad, but it's not. I'm gonna be honest, it's not great. So this is, again, looking at it from the Utah. This is specifically on the Utah market, on the particular house that I showed you, and the overall general numbers and calculations. So Lisa's now going to take it off and just give us a somewhat of a walk down on a comparison on maybe some private lending.
Yeah, so the private lending, if you are investing in a fund with somebody else, you can be looking at 10-12% returns depending who you're going with. I was just talking to someone and she's getting like 13-14% returns, but she was in second position. So when you're looking even at lending, and if you're looking at doing it passively, that's something also to consider. When she's telling me those returns, and she says 1 month it was like 16%. I'm like, how are you getting that? And then she had said they're sitting in second position. So if you're going to invest in something that is a first position lien compared to a second position lien, then you should be getting a higher return on that second position because it's much riskier. So if you're looking at something where, okay, I can put my money in and I can get a 10% annual return without having to do anything. Now each year I could be getting 10% annual return, where if I buy an asset that I have to manage, then that return is going to be different. Now you have to consider other things, what the taxes are, the benefits in that. So it's not just an easy, this gets 2.5%, this is 10%. Cool. This is what I want to go with. Because you also want to factor in what your tax benefits are going to be, what your financial situation is. There's more than just strictly what the return is, but you do want to look at that and be realistic with rentals. And I think right now and it drives me crazy when people talk about numbers, especially with rentals. And like that property right there, I could easily see somebody being like, oh, this will cash flow $1,000. And all that they're doing is taking, okay, here's what our rents are and backing out the PITI. In some cases, I've had people send me deals that only back out like principal and interest. And I'm like, well, what about like your taxes?
You don't have to pay taxes. You don't know that, Lisa?
Pay those. I'm like, they're not paying my tax bill directly. Like I'm paying that out of my pocket. So a lot of people, I think, very often, in my experience, exaggerate what potential returns could be for rental properties. And you really want to dig into the numbers and understand, like Chris said, you want to make sure you're saving for maintenance and vacancy and CapEx and all of those things. And you start to factor those things in and look at a realistic return. And how is that return compared to the passive and doing private money lending? Because you're not going to get the tax benefits of private money lending, but you're going to probably get more consistent cash flow. And you're going to know, okay, I'm going to be getting 10% on this loan that I'm invested in. So, and somebody had commented, I use my solo 401k to invest too. Yep. That's another great avenue. And yeah, taking all expenses for net cash flow. So it's not just a simple looking at the numbers and backing out your principal and interest. You really want to dig into what it is and what fits you. Like back to like, what are your goals and what fits you and what do you need right now? I've met several people in the last couple of years that have come to local meetups that were like, I'm quitting my W-2, I'm going all in on real estate, blah, blah, blah. And a year later, they're going, that was a terrible idea. Real estate is not for me. I love the benefits of it, but I'm going to just invest passively now. They had a great tech job. They're like, I'm going back to that. So you really want to figure out like what fits you, what works for you, and what your financial goals are. For me, getting heavily involved in active real estate got me out of my W-2, and that was what I wanted. I didn't hate my job, but I didn't love it. So I knew that I wanted to get into that. So I was willing to put in those hours, put in that sweat equity. We were buying value add properties, doing very heavy remodels, which is why we were able to get much better returns than a turnkey property. And another, like a turnkey property, you're going to get much lower returns than buying something that is completely vacant, that was a meth house, that is a terrible condition that you have to rip everything out, redo plumbing, electrical, all of that. So your returns should be much higher, back to like the risk and stuff on things like that. So back to, do I want to put my time into that, or do I want to invest passively, and do I want to do private money lending, or invest in a fund that invests in debt? So there's a lot of things to consider, and it's really just knowing what your goals are, what you're going for. But I've been loving the debt investing, and it's been a great avenue. So
Yeah, I think in general, you guys, like, I piggyback a lot of what Lisa was saying. It's really understanding what you want to look at. Like, again, I do not think there's a right and wrong. I would think the wrong would be dumping everything into one. Like that's where I would say is wrong. Like, you can diversify. There's nothing wrong with doing second lien positions too. You just gotta know you're taking on more risk and you're gonna lose more. But if you allocate the portion of your investable assets correctly, there's nothing wrong with doing it. I know people that make a lot of money doing it. So it's just navigating how you want to do it, and then asset allocation. Like, really look at how you're allocating your assets, what you want to do, right? You can definitely do it active. You can pick up these houses. I know people picking up brand new houses, especially right now, because the market is a lot slower. So I know investors, I want to say, and this is specifically in the Utah market, 40 something odd percent of all new builds are going directly to investors. So again, there's opportunities there. It's because builders need their cash flow back to be able to continue to build. They're reducing, they're giving all kind of discounts away. But then again, you're taking on the responsibility, you're taking on slightly higher risk, and you're taking on the responsibility. So do you have time? Do you not have time? So it's knowing what resources you can allocate, and you can definitely get all the tax benefits from passively investing as well that you can get from actively investing. It's just being able to find the right CPA to get that all set up and navigating again, and then asset allocation. How much of the assets am I going to have on high risk versus immediate growth risk versus low risk? And you need to have that allocation to protect you from any weird downside economic activity that will happen. It's not if, it will happen. It's happened multiple times in our life cycle. So you want to protect, you want to definitely get as much as you can on the upside, but protect on the downside. So
yeah, and having that SDIRA to be able to have that capital. Like I said, most people do not stay at the same company their entire career. Most people are moving around, especially now. I mean, some people every couple of years are moving or whatever, but odds are most people that are in corporate and in W-2 will have a 401k from a prior company that they could roll over and really start to invest. And they can do it as lenders. They can do it as active. It's just knowing, one, exactly what you can do with active and how to do it, but what's going to fit and where you're at. Like we discussed earlier, if you're 25 years old, you got a lot more of a runway. So if you want to be heavier on the riskier stuff, you certainly can. If you're 55, 60 and you're getting near that, you probably don't want to be too heavy in super risky stuff because you don't have as much of a runway to be able to claim back that money if you have any losses, and recuperate anything that may be losses or bad investments. So but self-charged IRA is just such a great tool. I wish I knew about them. I learned about them in college, but it was just one of those things that, like, you leave college and then nobody really, like, I never had a financial advisor talk to me about them. I never had a company talk about them. So it's like one of those things, like, you learn in college, or I did with finance, but then, like, never heard of outside of that. And now it's like coming back around, and they've been around. They're not something new. They're not this like new invention that came around. I think it was back in like the 70s that they first came out. It was really the last 20 years that they've really started to become more popular. But they're a great tool. And if you know how to use them and know how to use them well, you can really, really accelerate your retirement growth and your wealth growth by using them. So
I got a question for you. I don't know if you know the answer or not, but you mentioned moving from job to job and your retirement account. There's a lot. I think the last time I looked, there was like 48 or 49 billion dollars like unclaimed in retirement funds that were lost when they moved from one job to another. Is there any website that you know that scrapes that and can post back that information?
I don't know if there is, because I don't know how, because all that information
Normally
would,
stored with the employer.
yeah, yeah. I mean, my first thing would be like the employer, but yeah, I don't know, like to be able to scrape Fidelity and Vanguard and those because it's all private information. But
Like
I,
another
I,
business idea.
huh?
It's a business idea.
I 100%, my very first job out of college, I was there for a couple of years. 10 years later, I was going, I know I had a 401k with them. And it took me a while. Like, I couldn't remember what company it was with. And it took me a while to find the information on it and find the login and get that. So, like, it definitely happens. It's not, when you're not, it's such a, you do it when you start. And most people never look at it again. It's like, okay, I've set it up, I've put it into these accounts, and it's never looked at again. So it is not uncommon for somebody to forget where it could be, especially if it's an employer from 10, 15, 20 years ago. And you're like, oh, yeah, I did have one with them. So after that, I always made sure that when I left the company, I always was like, all right, within 30 days, I need to roll this over into my main account and keep everything together.
So if you guys are watching this, go back and call all of your old employers and see if they have any of your money.
Yes.
My son and my daughter both did in the last I want to say 6 months. I think it was sooner than that, but they both came to me and said, "Look, Dad, I have money that I didn't know I had." So it definitely happens. Go back and call your guys' employers and make sure that you got all your money.
Yeah, and that's actually a good question because Harmony says National Registry of Unclaimed Retirement Benefits. Because I know, having worked in finance, I know for like checks, if there's unclaimed checks, then there's definitely, like, as the company, like, you have to submit it to my mind is blank on what it's called, but unclaimed property. I know there's that, but the National Registry of Unclaimed Retirement Benefits, I've not heard of that, but it would make sense.
Well, Harmony Falker, thank you, Harmony. Appreciate you. I would say let's go. Oh, here's another one. She's on a roll here. Department of Labor's Abandoned Plan Search. These are 2 ones. So we're giving you resources. We're giving you resources to find money that you guys can go invest with. Harmony, you are great. Thank you for
I'm
doing
going to both of those just to make sure I don't have other ones.
I'm going to go on right after this as well because I didn't even know they existed. Harmony found it, and I'm going to go see if I have any leftover money somewhere. But Lisa, tell everybody how they can get in touch with us if they want to know more questions or want to learn a little bit more.
Yeah, so Retoro Capital Investments, that is our fund. You can visit our website and you can either book a call with us. We've got some resources on there. We have a retirement calculator that's really fun to go in and kind of mess around with. You can adjust like your age and savings and things like that. And there is a download for an SDIRA information guide that you can read more about and kind of dig into a little bit more. But yeah, if you want to book a call, you can certainly book a call with us. Visit our website, and we do these webinars regularly to just educate and make sure people are fully aware of all there is to invest in and what their options are. Let's get our website. Let me grab that real quick so we can. So the RetoroCapitalInvestments.com
/SDIRA will get you to our SDIRA calculator and more information on that.
I'll do a quick.
While she's pulling that up, let's just see if there's any questions out there. Thanks for the participation. Got a lot of participation going back and forth. So definitely appreciate that. And if there is no more questions, I would like to bid everybody aloha and ohiho, and thank you guys. Thanks, Lisa. It was super fun.
Yes.
Going over everything with you. I definitely enjoyed myself. Got to learn a little bit more and just talk shop. So appreciate you. Appreciate you, Lisa. Appreciate you guys. We will see you guys on our next webinar.
Bye, everyone.